Hey guys, how are you? Very glad to have Lyn Alden. Been looking forward to this one. Lyn Alden is of Lyn Alden Investing and also to be found on lynalden.com. We will include links both in the show notes and in the final edit. Lyn, came across you mainly when you had that interesting discussion with Brent Johnson via the Real Vision links. We were introduced to Brent, and then your counterpoint, you had a very interesting and detailed discussion with him. Subsequently followed your research and found there's a really lucid mind out there that's got immense detail. Thank you very much, A, for coming on the show. And yeah, tell us how it's been, what your core interests are initially, and how I suppose the first question leading on to that, the dollar milkshake theory, how you position yourself and where we might see some of the differences in view versus yourself and Brent.
Sure. First of all, thanks so much for having me. For people that don't know me, so my background kind of comes from a blend of engineering and finance. So I started out in engineering, and I shifted over to finance over time. So I take a pretty quantitative look at things. I do a lot of long-term, kind of really long, like ultra long-term number crunching, things like that, trying to find historical analogs, trying to find very long-term cycles playing out. My current interests are basically that we're at kind of the apex, or kind of in the ballpark of being in the apex of a long-term debt cycle. And there's different ways to describe that. That's, for example, Ray Dalio's term, but there are a couple different ways to describe that. And so basically over the typical business cycle, which lasts 5 to 10 years on average, debt accumulates, and then they have a recession. Some sort of catalyst hits when it's already over leveraged, and they have to basically deleverage. And we have a recession. We work out some of the excess, and then they start building up from there. However, it never really deleverages all the way. It kind of deleverages maybe halfway, and then they start building up from there. And central banks cut interest rates and do all sort of accommodative things, and that encourages more debt accumulation. So over the course of maybe a dozen of these business cycles over the course of 50 years or more, you end up building up extremely large debt levels. And in addition, private debt keeps building up, but during those recessions, usually the government comes in and does extra fiscal stimulus, so they start accumulating sovereign debt as well as a percentage of GDP. And so when you kind of run into the zero bound, so interest rates are at zero and debt levels are extraordinarily high, that's when we start to get into other tools. And those tools are often confusing to people because it's usually decades since they were last used, and they always seem like they're unprecedented, but really there's different kind of ways to use the same sort of tools over and over again through history. And so a lot of my focus is on kind of where we are in that cycle, and how that can affect things like currencies, precious metals, equities, treasuries, emerging markets, commodities, things like that. I have a pretty broad view. I go down to both the individual stock level and the macro level. So as it pertains to the dollar, you mentioned Brent. We've gone back and forth a lot. I have a lot of respect for him. And we agree on a lot of facts. I think we see the outcome a little differently. And I don't want to put words into his mouth. I think he can describe his views the best. But essentially, the way that the global monetary system is constructed, the dollar is the global reserve currency. In addition to most commodity pricing happening in dollars around the world. So if Europe buys oil from Saudi Arabia, they pay in dollars, even though the dollar is neither of their currencies. That's the whole point of the dollar as the reserve status. In addition, countries keep a lot of treasuries on their books, so that they have a reserve of dollars, essentially. And in addition, a lot of international lending happens in dollars. So companies around the world, as well as some governments, collectively have trillions of dollars of dollar-denominated debt. And that essentially represents demand for the dollar, because you need dollars to service that debt. And so the problem is that kind of creates a ton of demand for the dollar, which keeps pushing it up. And you can have a lot of currency crises because if, say an emerging market has a lot of dollar-denominated debt, and then they have a crisis and their currency weakens, they basically the value of their debt in local currency terms goes up because the dollar strengthens relative to their currencies. And that's why emerging markets exhibit more boom bust characteristics than developed markets, and why they tend to be prone to currency failure, currency crises, inflationary crises, things like that. So I know Brent's long-term outlook is for a stronger dollar, and that's where I disagree because I see kind of some forces on the other side of that can kind of push the pendulum back down. So we kind of start from the same set of facts, but then we see the probabilities for how it plays out as being somewhat different.
Yeah, I like that. If I was to encapsulate a little bit of how he sees, and we all price behavior futurists, we're all asking how does it play out. It seems by virtue of the offshore dollar denominated debt, in the event of people not being able to pay, it's highly deflationary and that collapses in, which causes a further demand in his worldview and dollars dying at an accelerated rate. And as a result, that leads to additional demand, even though there has been this superfluous supply. And I kind of spoke about the one thing that it felt like is that I certainly feel the emerging. I talk about currencies in a village of dominoes, almost circular, and some of which are even outside the main walls. In terms of how the peasants used to live in the castles of the monarchy, and the weakest currencies with the highest dollar-denominated debt might be sacrificed first. And there's this, the rand, the lira, and you mentioned Chile and various others that don't have particularly advantageous dollar debt to GDP percentages, being one of those that fall first, and that as they collapse in, the people will go to might being right, the biggest and most proliferated and easiest for exchange and broadly globally known, almost as a brand. Not that they love McDonald's, but they know exactly what they're going to get, in essence, with the dollar. And that's Brett's synopsis. And as they collapse in, and the need for them to have currency drives a sort of spike in the middle, where the largest domino being the dollar first goes up before, and in fairness, if I'm to be the devil's advocate and stand in for him as best as possible, he does see gold being the eventual winner, but that there will first be a massive appreciation in the dollar as those peripheries collapse inwards towards the center of that circle, and gold gets gold actually rises on a rising dollar until the dollar is no longer particularly necessarily rising, and we have this new financial system. How do you see that differing from that sort of maybe that by force of necessity fiat crowding into the dollar? Where do you diverge?
Sure. So the dollar milkshake theory I know involves the dollar going up with equities simultaneously. So you have a big kind of equity bull run and a dollar bull run at the same time. Historically, those tend to be somewhat inverse, right? So for example, in this current environment, the dollar, for example, it peaked in March and then it's
Yeah,
been on the decline, whereas the equity market bottomed in March and has been on the uptrend. And there's
yeah,
actually a pretty good reason for that. And that's the part I think that some of the dollar bull analysts don't focus on enough, or the way that the variables that I kind of bring into discussion and kind of emphasize probably more heavily, is the fact that in addition to having several trillion in dollar denominated debt, countries around the world collectively have about 40 trillion in US assets.
yeah,
And that includes equities, that includes treasuries, that includes corporate bonds, that includes US real estate. Uh,
yeah,
and Many countries, for example, like Japan, they own more foreign assets than foreigners own of their assets. They have a positive, what's called a net international investment position. The United States is the opposite. So ever since roughly the 1985 or so, we foreigners own more of our assets than we own of their assets, and that's because countries that have positive, it's NIP for short, NIIP. Countries with
yeah,
positive countries with positive NIPs have they basically they run trade surpluses for a long time, and that gives them all the foreign currency that they go and they buy foreign assets with. And so their central banks usually hold a lot, and their corporations and their people, they hold a lot of assets, their pension funds, things like that. Uh, on the other hand, if you run persistent trade deficits, our dollars are going out in the world, and the world's kind of investing those dollars into our assets. And over time, in previous emerging market crises, so we have every time there's a dollar spike, and there's been three big ones since 1971. There's this big spike in the mid 80s, there's the big spike in the late 90s, and then we're currently in the third spike ever since about 2015. And every time that happens, emerging markets start to break. So in the 1980s, the emphasis was on Latin America. They started to have currency crises. In the late 90s, it was on South Asia and
yeah,
Russia. And then lately, it's been more spread around. We've had Turkey, we've had Argentina, we've had Chile's under some pressure. It kind of, as you go down the kind of, as you said, the ones that are outside the moat kind of. Uh, and But the issue now is that over time, the net international invest position of the United States keeps getting worse. So foreigners keep owning a larger and larger amount of our assets, both in absolute terms and as a percentage of our GDP.
If I can cut
So
in there, won't they, as the dollar goes up and we've had an overperforming stock market on the US, which has diverged in its overperformance relative to all the other nations, isn't that a momentum seeking tool that's only going to see them want to crowd further into that room? In other words, just devil's advocate, people chase the flow and the momentum. And you could, in the same way we talk about a gold going up and at the simultaneous event as the dollar going up, you could in time have increasing equity prices on a stronger dollar as part of this extremity where everybody just rushes to the only corner of the room where things seem to be worth holding up.
I think to some extent. So we've actually kind of seen that since about 2015 into March 2020. So for example, the dollar strengthened in 2015, and since then we've still had very good equity performance. And that's a lot of it. It's because over that period we've had kind of a static dollar. So it got really strong after QE3 ended at the end of 2014, and then since then we've had a choppy sideways dollar. And so
Yeah.
that's been the third quote dollar spike. And it's been an environment that it's not great for global growth because it puts a lot of pressure on those emerging markets, and that's where a lot of the world's growth engine is. But it's not gotten to extremes, except in those two moments roughly in 20. You can see on the spike there, the 2016, and then again in March 2020 when it started to break. And those were kind of associated with sell-offs. So
Yeah.
part of it has to do with speed. If you get kind of a gradual strong dollar, you can kind of get gradual strong equity markets. Eventually, it hits a breaking point just because the pendulum is so far to the side. Everyone is already all in. You kind of run out of buyers. But
Yeah.
definitely, that momentum trade can continue for years. And for example, I think the dollar milkshake theory was correct for several years. I think part of my differ is where it ended. So when the U.S. started cutting interest rates, and then particularly at the repo spike in 2019 in September, that's when I shifted more bearish on the dollar. Specifically, right in early October is when I became more of a dollar bear. So in 2018 and early 2019, I went from dollar bullish to dollar neutral, and then in October of 2019 is when I turned more dollar bearish, and that was
Right.
on the dollar index was around 99 at that time. It dipped, and then we got the March spike, and then we've gone down since then. So now, of course, the big question is whether or not that's the spike and we're on a downtrend now, or if this is kind of like 2017 where we got that big decrease, but then it ramped back up again. And that will depend a lot on fiscal monetary policy. There are a lot of things different since then. And so to answer your question about momentum, essentially, if the dollar gets too strong too quickly, that's when something breaks. And
Yeah.
so the momentum trade generally fails because in an emergency situation where countries need dollars right now, they have to sell treasuries. So
Yes.
we saw that in 2016 when we had that big dollar spike, foreigners had to sell some treasuries, and then we saw it again in March 2020 and April where the dollar spikes. So you have countries like Saudi Arabia and other countries that need those dollars sell treasuries, and then because there's more sellers than buyers, essentially, the treasury market in March became the most illiquid. It essentially broke. It almost went no bid. The what's supposed to be like one of the most liquid markets in the world, treasury market, became illiquid. And so the Federal Reserve ended up buying $1 trillion worth of treasuries in 3 weeks in March.
Aren't they always
And
going to be that buyer of last resort, though, just to keep the game ticking over? Won't they always
yes,
stand up and be that guy just to maintain it and to buy more time? So, in that sense, is that just not the default? I don't know what you call it, almost monetization of debt. I don't know if that's the right phrase, but isn't that just going to be the same playbook?
essentially, but that's the release valve. So for example, what we had, you can call it a treasury oversupply or a dollar shortage compared to how much debt is in the world. There's different ways to describe it, but when we have that kind of come to a apex in March and the system started to break, that's when the Federal Reserve just came in and basically created a trillion new dollars, and kind of there's technically bank reserves, but they created a trillion new dollars and they took a trillion treasuries off the market. And so a lot of those foreign, places that had treasuries now had some dollars, and they could pay off dollar-denominated debt. They could at least service the dollar-denominated debt. They could avoid a big liquidity crunch.
Just coming in on that, doesn't that just mean that a previous investor that held treasuries offshore now has reduced ammunition to do that again, and that's just been moved onto the Fed balance sheet? In other words, we've reduced their net investment in treasuries by virtue of actually just monetizing that onto the Fed balance sheet, thereby actually reducing that effect for the next cycle around.
To some extent. So that's what happens to crisis areas like, say, Argentina or Turkey. They start to run low on FX reserves. However, what we've seen since the March and April sell-off in treasuries, foreigners began accumulating treasuries again once the dollar weakened and there's more liquidity in the system. So there actually hasn't been a significant reduction in foreign FX reserves. It's remained relatively static. So basically, the Federal Reserve is forced to shift to a more dovish policy, initially starting with the repo spike in September of 2019, and then more aggressively in March of 2020. And so we've had basically more dovish monetary policy, which means more dollars get out there. There's more liquidity in the system, and so during that brief period, we did see a reduction in foreign exchange reserves, but they slowly worked that up. And if you look at all three of those really long-term dollar spikes, we see that play out again and again. So when the dollar gets really strong, the foreign sector generally stops buying treasuries, or at least sharply slows down their treasuries. So they end up owning a smaller share of U.S. treasuries outstanding. And then once the Federal Reserve is essentially forced to shift to a more dovish policy stance and the dollar weakens, that's when they go back to accumulating treasuries again.
Okay. The other thing the Fed's famous for not liking is sort of disorderly descents and maybe ascents as well in either direction. We did, of course, have quite a momentous move up. You were referring to the end of the QEs from 14 up into 15. That took the dollar up to the 95, 97 handle. But we've also had quite a steep sell-off so far as well, but it's not yet chronic. It's certainly smaller so far than that bull move, and it's probably not yet on the scale of that pullback, and we remain in there. But at what point do you think the dollar itself becomes a bit of the issue, and they have to say, well, we've lost too much ground? For us, just to add to that, at a technical point, we no longer consider as macro technical analysts in terms of what we do. We still maintain there's a slight possibility. In fact, it might still be our base case that this could still form a continuation pattern that just calms down and maybe has breaks to the upside even, or it could wind up and break to the downside. But this is not critical until we actually, it's not a critical reversal potential until it runs this level of the lows that were engaged around about 2018. So in terms of the dollar valuation and where it is now, where's your view? Do you think we take the orange line on the downside, sub the 88 handle? Just as your base case?
So for me, it's in terms of probabilities. So I turned dollar bearish in October at around 99 on the index. Now, because we've come pretty far pretty fast, that actually removes a little bit of my bearishness, because now the trades become a little bit more crowded on the short side. And so, for example, I've been kind of expecting a little bit of a bounce here. My base case is that the March spike that we saw up to about, I think it was 102, 103 in the dollar index. That is kind of my base case for probably being the top in this cycle. There's certainly still a possibility we'd break above that if, for example, we had another big liquidity and solvency crunch, and whereas in March they did a ton of fiscal stimulus and the Fed monetized a lot of it, so we just kind of flooded the system with dollars. Even Jerome Powell described it as like that. We just flooded.
Isn't it safe to say though, Lyn, that that's almost pretty much a high probability event? It's not quite, maybe the timing of that's not going to be necessarily that easy to put a finger on, but given where we are and the precarious nature, it kind of feels like we're walking a plank across two cliffs, and the plank is actually tapering. because on the one hand, you have the FX emergings that will collapse if we get too much dollar strength, and that's going to precipitate the domino effect that we fear. Yeah. And on the other, so that's the dollar can't get too strong. We're getting ever more sensitive to this balance. And in essence, if it gets too weak, we may have, as you argued, for example, the equities getting ridiculously overvalued, a variety of other aspects that become an issue. And you're kind of on this tapering plank and you've got to cross the other side, and it's getting ever so thin to the point where you might get in a point where either way you're infuriating either case.
Yeah, no, I think so. I think it's kind of a big control system here. So there's two competing forces, and they're both very strong. And so my longer term outlook is that I do think we're going to probably end this dollar cycle and go down. The big question is the path that we take to get there for me. So if monetary policy, I expect it to be very accommodative for this. I think they're aware of a dollar spike. They have, swap lines open. They've been reducing them because the demand for them has decreased, but they're still open. They're still available. And no central bank that has them actually took out the maximum amount allowed. So I do think that on a monetary perspective, they're kind of aware of that kind of March scenario happening again. I think the bigger question is what they do on the fiscal side, because at this point, I think, monetary policy is kind of out of tools. They can just kind of sustain the current environment. They can't really loosen much more. They can just not tighten, essentially. So they can keep all their tools open, and it's really about the fiscal authority, and that's harder to predict.
Can we come back to the fiscal? Because I just want to jump in on monetary. I have a document here it was an IMF thought paper document that spoke about breaking the barrier of zero. And in our pre-interview question time that I did with my premium community, I asked for any questions that they may have. And a few people were interested in your take on the negative interest rates. In this paper, it actually talks about the scope. In fact, I'll just bring this document onto the screen share and we'll switch from the charts into it. This was an IMF working paper. You haven't had benefit of sight of this, but breaking through the zero lower bound and how you would deal with cash, which obviously would then have a positive carry if you're charging negative, how they would actually create a charge at the bank, or they would have a negative interest rate on cash to make up for the fact that hoarding. Just curious on your take, because that's a very interesting rabbit hole that we could be taken down as this is developing, and it won't necessarily all happen at once. This could be something they introduce on that bound. Where do you stand on the bound? And of course, we have all the European bonds on a high percentage on negative interest rates. So on that monetary policy, negative interest rates, what's your overall feel? And then we'll delve into the other half that you're about to kick into.
Sure. Yes, I'm familiar with that paper. Basically, there are kind of two paths they can go down now. So they can do more fiscal, or they can try to go deeper and deeper into negative rates. And I think that second path is the bigger mistake out of the two. So I think going down into deeper and deeper negative rates is basically just kind of the worst of all worlds. So for example, so banks, for example, would be utterly just killed by deeply negative interest rates. Yes. And kind of the natural limiter here, and you touched on this, is that if rates, so it's one thing for treasuries and foreign bonds to trade slightly negative, right? So you can almost consider it like a storage cost for holding cash. Like it's, yes. if they're say less than 100 basis points negative, it is what it is. But once you get into like several full percentage points negative, there's a much stronger case to literally just take cash out and just hoard physical cash. And so then they have to turn to those measures to try to like reduce physical cash being pulled out from the system. It basically the whole global kind of banking system is just not designed for negative rates. There has to be an incentive to keep money in the bank. And if there's a really strong incentive to pull money out of the bank, it either crushes the system, or they have to turn to more authoritarian measures to try to kind of ban people from taking those defensive measures.
But that's the part of what that paper suggests, because they almost have a negative compounding cash carry that they would enforce for any transaction to try and mitigate that negative rates. Of course, as precious metal bulls, which gold and silver has no scope, it just makes the case for gold and silver a whole lot stronger. So I suppose if we're bullish, and we're expecting this to go down. We're almost partly wishing for it if we've got a sufficient allocation in precious metals. But so you don't think that they can go there? Bear in mind how far they've gone in Europe. And do you think it's different for America because of the proliferation globally of treasuries, while maybe European bonds, debt's not quite the same category because of the global currency status and various other things? Do you think there's a sort of step up? Wow, that's a whole new game if you're going to go US goes negative
Yeah, I think
because
yeah, so a lot of these like Japan and Europe have because they have positive current account balances, right? So there's unlike the US that runs trade deficits and current account deficits, they have surpluses. So they kind of had this more disinflationary environment ahead of us, and so they can more easily go negative. If the US as the world reserve currency goes negative, things get interesting pretty quickly because more compared to those other places, more of our debt is held by the foreign sector. And so if treasuries, for example, are yielding -3%, that strongly entices foreign central banks to do alternative things, like to basically buy gold and to start trimming their treasuries. And so that essentially starts kind of ending the dollar's role as a global reserve currency if we go deeply into negative rates and stay there for a long time. Um,
maybe that makes it a final touchstone, though, in the end game that has to be passed through, a sort of gateway that has to be crossed. So they're obviously going to maintain the system in its unraveling state. It's not something they're going to reach for too quickly, but it will be the gateway. It will be kissing the ring for moving to that final stage.
it's
Yeah.
it's it's possible. I think there's two ways to look at it. So if we go back to the two choices when you hit the zero bound, you can either do more fiscal and basically money printing, or they can go try to deeper and deeper into negative rates. So if you do the more fiscal route, you end up still getting to negative real rates most likely because you see a rise in inflation while nominal rates stay, say, low but positive. And so you get a negative real rate in that way. If you go down the negative route, negative nominal rate route, that's probably because they're not doing a lot of fiscal and the central bank's trying to use their tools more. So they're going ahead and they're going deeper and deeper into negative territory. And so you probably have a very low inflationary environment, possibly even deflationary, because you probably would see, for example, a gridlock in fiscal stimulus, either in the US or the Eurozone or both. And so the central bank's trying to do more and more things, trying to go deeper into negative territory. So you have kind of low inflation, but even lower nominal rates. And so either one of those scenarios can be good for precious metals, for example. And both of them are just
That's
Ugly
what I'm talking about,
comparisons.
that tapering plank, the two sides losing, and the only one that wins is gold as it gets thinner. I think you're right. I think they're going to go fiscal first. So let's let you sidebar back to where you were going to the fiscal side. On that comment, we've done a sort of gold precious metals reflated or deflated relative to shadow stats. I'm not sure if you're familiar with John Williams's work,
yes.
and then we did it also on BLS, which is the official government stats. But as you know, they keep changing the parameters, which helps hide a bit of a lie sometimes.
Yeah.
So we did a deflator on gold, and actually, if you look at gold nominally in the current dollar, just at a nominal level, then you do a deflated by government stats, and then you have a look at John Williams' more shadow stats orientated aspects. It certainly seems like actually the gold and silver bull is really only just started. I did charts off that with the deflate, and we took John works off the 1982 Reagan era base case. Just on that point before we go into the fiscal side, what is your comment on the official stats and where we are with our positioning? Is it as early as I think it is?
I do. So I consider kind of maybe middle innings, maybe not super early, but I think that partially depends on what plays out. I do think that over the full 2020s decade, I do think we could see very strong precious metal performance. So I kind of taper my view based on how far we go. So for example, back in 2018, I was very bullish on precious metals. Now that we've gotten a stronger run, I remain long-term bullish, but a little bit more concerned in the near term, maybe the next 6 months, a year, that kind of time frame. Uh, you know, I don't really have strong views on the short term. Uh, I do think that longer term, I think still gold has and silver have a very long runway to go because I think we're going to see essentially a lot of money printing over the 2020s, and I think we're going to see persistently negative real yields. There could be brief periods of deflationary shocks or other things where real yields briefly turn positive, but I think for the bulk of the 2020s, I think we're going to have negative real yields.
Yeah, I think you're absolutely right. I'm just going to take you to a chart because it's almost historic, Lyn. We've of a view that silver is going to be a particular outperformer on gold. We've done a fair amount of macro technical research on the gold silver ratio and other aspects. Do you have a word for silver? And before I do that, I'll just show you because the dollar's been a tad weak and we had the Fed talk here that led to the spike that I'm illustrating. I'm going to show you the silver versus euro. This is actually a little bit short term and it's just fun because it's Friday. We had them talk yesterday, so it's a little bit topical and my date stamp this day that we're chatting together because I think it's quite a significant moment. But technically speaking, we are seeing a run for the 30s handle out of this continuation pattern. I'll just throw it out to you because it's quite interesting. And then you can tell me your macro view. I know you're not officially a technician, although you do enjoy the charts. But we're seeing a bit of a break where we see the 30. This is gold euro, by the way, so it's not 30 on the gold euro chart. But that this might be a triggering event on the dollar to run 30s and that we might get upper 20s on the euro right now. How do you feel macro about silver, this short-term possible event post-Fed aside?
I think so, and I actually think so. If you go back to tie that into the fiscal versus monetary route,
Yeah.
so if you look back historically at gold and the silver, it in somewhat of a more kind of disinflationary. So either way, they both tend to do really good when there's deeply negative real yields.
Yeah.
Which one does better partially depends on whether it's a disinflationary environment or a reflationary environment. So for example, from 2018 into that March bottom of 2020, gold outperformed silver because that we had basically slowing GDP growth, we had kind of slowing inflation, but nominal yields were coming down faster. So the treasury market started to basically price in kind of a recession, essentially. And so in that environment where both nominal yields and inflation are decreasing, but nominals are decreasing faster, that's really bullish for gold because gold tends to be a defensive asset, whereas silver is a more aggressive asset. So gold had outperformed silver in that environment. Now, since the March bottom, it's been a more reflationary move. So we saw, inflation expectations collapse in March and then rebound when we got, trillions of dollars of money printing. We've seen reported CPI increase. We've seen inflation break-evens increase, and nominals have stayed pretty low. So we're in a pretty negative real rate environment, but it's a more reflationary environment, which is better for silver. So I think going forward, kind of depending on which path plays out, if we don't get a lot of fiscal and instead we kind of stick with the monetary route of things, I do think we could see kind of a pullback a little bit and more gold outperformance. On the other hand, I think if we get kind of another big round of fiscal and that sort of more reflationary environment, I think that's an environment where silver can potentially do better than gold.
So stimulus package to come out, say, prior to the election. I don't know if that's going to work out and how keen the Democrats would be on that. But any sign of man in the street getting a bit of largesse, so to speak, COVID-19 or any other reason, therefore, you'd see as being particularly beneficial for both, but silver particularly.
Yeah.
Yeah. And if we were to have a little bit of concern regarding the Nasdaq, it's interesting to hear how you defined it, reflationary and deflation in the first instance. I kind of always felt of gold as what we refer to the God market, the lower beta version of a volatile pair. And the fear is going to pull them both down a little bit when there's the deflation. And I kind of explained it away. We're just going to, relatively, the higher beta will pull back harder. Is it not just explained away in the fact that silver is just a higher beta, more schizophrenic version of gold rather than specifically reflationary or deflation? Because in essence, the results and the outcome typically are the same.
I think to some extent, I think basically in a more kind of slow and growth environment, investors flock to the lower beta of the two assets. I do think there's also somewhat of a fundamental component because silver has, about half of its demand is industrial. And so that can face a little bit of pressure in that more kind of slow growth environment. So I do think it's partial, but then investors, of course, know that, so they front run that and they exaggerate that even more. So I do think a lot of it just comes down to the fact that gold is a lower beta kind of traditionally safe haven asset compared to silver.
Yes, that's right. And also a bigger market for liquidity, so you probably have less panic selling. I'll bring up, if I can, and I'm interested on this, but maybe you'll comment on it. This is the relative value of gold, silver. We've done a gold silver ratio, and this I kind of try to capture a fairly long period of history because you're very macro. It would be super cool to get your take on the relative valuations, although we've probably said quite a bit on it already. I just think it's great from a point of view of getting the history. Sorry, SI is what I want. Silver futures. Let's grab him. So what I'm just going to be showing you is a long-term take on the gold-silver ratio using the futures. And we'll go up to the monthly and we'll put an eye on it. This chart. It goes back to around about early 70s, which I'd love to have more data, but this is the cycles. I part holding out, and this is a theory, and criticize it, kick the tires to suit. And this is obviously a bit of a blue sky call. We're sticking our neck out. We like to do that. But we've actually had on this, dividing the gold futures by the silver futures, we ran an all-time high by my understanding, although you won't see that there's not sufficient history here, of 126.6 on some, depending, you'll be close to 128 in terms of silver ounces to get a single gold ounce. The pullback on the gold-silver ratio has been one of the most violent. In 4 months. You've gone from about 126 down to the 71 level. You actually dipped just below 69. In the essence of natural geometry and an overshoot to the one side, precipitating as chronic an undershoot to the downside. We were almost asking the question, and that the last and biggest low of the modern era, if I can call my generation the modern era, 16.5 was the lowest. And I'm assessing, and the reinflation of the gold silver ratio went up to 102 in that cycle. I'm also asking the question here, is it not feasible that we get a sub double digit, maybe 10 or just below 10 on the gold silver ratio, given the momentum, and also that this is probably an end of cycle in that you were talking about the 10-year cycles of debt and all of this. It's almost like we've had our 7 goes. Now this is one super macro cycle that's coming to an end. I expect an entirely different financial world when we emerge out of this. It's got an economic case history, multi-generational significance. Without being a drama queen, I do have that feeling, just because of the extremity of it. Is it feasible? Could it happen? What probability would you place in it? Any comments on this chart that I've put up?
Sure, I think it's a great chart. Of course it's feasible. I think in terms of probabilities, once that kind of came down a lot further, I'd get more cautious about silver personally. So instead of kind of reaching to try to see how far I can squeeze that trade, that's when I would start to kind of de-risk a little bit. So my base case would be as we go deeper into this decade, as we get closer and closer to this apex of this precious metal run, wherever it ends, I do think that ratio is probably going to come down because we'd be in a more reflationary environment, probably at that point outright inflationary environment, and so I do think you'd have that gold to silver ratio converge a lot lower. Now, whether it gets all the way down to that 1980s bottom, I don't know. I try not to kind of bet that extremes will happen. I think we're going to normalize. I think we're going to kind of come down a lot on that ratio because we're still above average. So we've come pretty far pretty fast. I'm a little bit concerned about that average in the near term, especially if we don't get stimulus and we're kind of gridlocked for a while. But looking out, say a decade, I do think we're probably going to see much lower on this ratio. And I kind of leave it an open question of where we end because that there's always kind of details that you can't predict. Like, so for example, the 1980s had the Hunt brothers try to corner the market. So if something like that happens, then sure. Uh, and so it's kind of hard to predict the details of especially because a lot of it's sentiment. If you have like a blow off top in silver, you can get all sorts of crazy ratios. You can get a 5-to-1 ratio. Whereas but that's tended to be a very brief moment in time. Whereas once we get, say, below average is when I would start to get concerned and probably start to de-risk my silver trade a little bit.
I'm not suggesting to hold 100% of your silver for that. I kind of feel as you get to the 30 lows here, you know, maybe a first 25% could be reduced, and if you get to the 20s, another 25. If you get mid-teens, you should be halfway out already. And looking for yeah, that's kind of my take. But I would probably keep one quartile just to see if you can get pretty close to that top, just because of the gambler in me.
Yeah.
But I'm not. That doesn't constitute necessarily wise, prudent advice. My bigger concern over that is that once again the system might intervene to stop us from harvesting at those extremes, and that it might be legal questions of private gold ownership might come into effect, because if it becomes, there's a lot of gold, you know, fringe media, a lot of gold fans, a lot of people start rushing it. If it starts to become too scaled, it will gain too much momentum. Actually, I fear that most people have too small a percentage in their portfolios. And even if we went from, you know, at one point as a South African who grew up through the 70s, 80s and 90s as a young tyke, people mandatory head up to 20% or 10% of gold in their portfolios. And I would think broadly right now, that's when we're probably doing well to have much over 1 or 2%. So if that volume came in and started, if we're early adopters and the mass of the bell curve started to move, it could get disorderly, and external disruptors to try derail that momentum might come into play. Do you think? What do you think of? I mean, it's a guessing game for all of us, but do you have a thought on that?
I do. I think basically there's a big wall of worry to climb, which is good for any kind of healthy bull market. So for example, over the past 10 years, equities have climbed a wall of worry. There's always kind of reason to sell equities, and they have these periods where they have corrections and they just kept going higher and higher. I think, you know, in the 2020s, we're probably going to see a similar thing with the precious metals, where they take two or three steps forward and then a step or two back. Because, you know, maybe you get a period of stronger growth, so you get kind of some real growth in there, and then you get people sell precious metals, but then they realize, oh, it's running out again, we have to buy precious metals again. So I do think we're going to see these fits and starts along the way, and going back to the whole thing where they made it hard to own precious metals. One thing I like to look at is there's a very long-term chart that shows of real treasury returns. So if you bought treasuries in any given year, you know, over the past roughly a century, and then kind of tracking how they did in inflation adjusted terms over the next 10 years. So if you bought a 10-year treasury and held it to maturity, and there was like a roughly a 35 or 40 year period from the mid 30s to the mid 70s, where if you bought and held a 10-year treasury to maturity, you spent most of those years losing money, essentially. So there was a brief period in the 50s where you could earn like maybe 1 or 2 +% per year, but for the most part, treasuries were like a losing proposition. And the period where Americans could not own gold almost perfectly overlaps with that period. It was literally from the mid 30s to the mid 70s. That was like a perfect overlap where you couldn't own gold. So you couldn't own one of the release valves for the fact that treasuries were providing negative real returns.
Yeah, that's a very interesting point. I mean, I can give the counterpoint to that takes you from the rest of there. My brother was an actuary and ended up in investment management, was a bond trader portfolio, and he essentially qualified at 22, 23 in the early 80s, and essentially was net long bonds his entire trading career, because we had the Volcker peak around about the late 70s into the early 80s, and he literally rode the bull market, and it's still a bull market even though he's technically retired. It's an entire career bull market, which once again brings that sort of end of cycle feel that they've almost done too well in capital appreciation, and now's the time for the evening and a bit of the darkness. I'm going to segue here, Lyn, and I want to highlight your newsletter. It's very impressive. I found it really, really interesting, and I'd like to suggest to everyone watching, go over to lynalden.com. She has a free newsletter. It won't cost you a thing. Jump on, give your email, and you'll start getting some really interesting points. What, Lyn, you just brought up now was the equities, and it almost feels, like we've had this perfect environment. I must make sure I get the big tax shift. That's it. The equity bull market that's been so strong. A lot of people, I'm kind of uneasy personally about equities because I think we have an overvaluation situation. It's the wall of worry basically that you talk. I just don't want to be a bag holder. But I can see them going potentially higher on this disproportionate hypervaluation. To me, everybody says, where's the inflation? And I say, well, where's the money being created? Who's it being given to? And go find the asset inflation there. And the equity market is part of that. It's gone to big corporates. Nobody wants to lend to SMEs and to everyday people in the street who might be furloughed. Banks want people that have a government too big to fail guarantees to make sure that they haven't made a stupid decision. And if it doesn't get paid, it's the whole system is failing. And as a result, this has given us sort of a special room for the insider cartel, if I dare use such a phrase. And we've almost had that perfect asset circumstances. And your tax policies document was really interesting. I particularly like this chart. I'm going to focus on it a little bit. And I'd love for you to give us a bit of feedback on it. But my quick summary, and for you to develop further, was that in essence, we used to have far more corporate profits charged at the point of profit being made by megacorps. And it seems to me that the corporation tax, that in the blue, is being taken back down. And in fact, far more is now coming out of the social insurance payroll taxes, which I'm sure you'll point out the role of healthcare in that as well. So this has grown super big now, where that one has grown a whole bunch thinner. And this was almost, you get the society you incentivize, and in essence, the net effect of this has led to a super corporate class, because we're going to talk about breadth, and it's just narrowing and narrowing, because if you look at the S&P without the majors, that actually outsource. We want great devs, go to India, get a local manager there, have a corporate head office in America, do as little recruiting as possible in America. The cost of employment so high, you'll pay 50% on health and various other contributions. And this has almost created the idealized situation for super profitability for megacorps. And that, of course, makes it more attractive to offshore investors. So that brings external investment money into US funds. Give us your take how we've almost created the perfect. They've almost supported Brent's and possibly your theory as well of asset price inflation, supervaluation going on in America.
Yeah, so we've pretty much done everything we can from a policy perspective to reward corporations in general, but then also just the subset of the least labor-intensive corporations. And so if you look at the multi-decade chart, effective corporate tax rates at the point of profit have gone down dramatically. And at the same time, we have two forces that are increasing the cost of labor. And so one is our healthcare costs per capita and as a percentage of GDP are the highest in the world. So we Americans pay roughly twice as much, almost twice as much as say the typical European or Japan. So there's that, and employers have to pay a lot of that because that's how our system. It's partially on the employee and partially on the employer. So if you hire an American worker, you're hiring. They're so expensive because of healthcare. And then two, as we've reduced the corporate tax rate, we've increased the payroll tax rate, and so we've shifted more and more of basically and of course corporations pay part of that payroll tax rate. They pay half of it. So over time, we've increased the tax rate effectively on labor-intensive companies, and we've decreased the tax rate on companies that are not labor-intensive, like software. And that's, of course, we've seen these big kind of hyper companies come, these trillion-dollar market cap companies come, because they're very kind of in many ways not labor-intensive. So they either do software like Microsoft and Google and things like that, or they do hardware, but then they automate a lot of it and
and offshore it. Offshore the manufacture and all the cost in nations that do not have the same cost of employment and these onerous levels. Because as you say, it's not just the package. that you're paying in wages. It's all your share of their mandatory contributions. Yeah, so that's a fascinating one, and it seems to be I think it seems an accelerant of the tech oligarchy and potentially the pharmaceutical oligarchy as well, where you might have a couple of high-end salary lab researchers that you keep at home, but you can even offshore some of that. And then a corporate head office, and there's not anything huge being made. All the actual production can be done in factories in China, India, across Europe, or anywhere in the world almost.
Yep, and a lot of this ties into the global, the dollar as the global reserve currency, because this goes back to all the way to when they started it, the Triffin's dilemma, which is in order to run the world reserve currency, like say we have a system where all countries need dollars in order to buy oil, for example, because almost all oil is priced in dollars and other commodities as well. If we have that system in place, it means there have to be a ton of dollars out in the world. So we can't for America can't run big trade surpluses and not put a lot of dollars out there if they all need dollars to buy oil. So we have
what you're saying is you run deficits. You have to run deficits, and the rest of the nations have to run relative net surpluses to you. Absolutely. No, and that is a dilemma. And it's almost like you're born with the pill that kills you. It's sort of a natural course in the birthing of the system. It has that dichotomy.
Yeah, it makes it so a global reserve currency is very long lasting, but inherently not permanent because it has to basically chip itself away. And so the question becomes, if you have to run big trade deficits, what areas do you do them in? And so the U.S. has done it in goods manufacturing. So our goods trade deficit is where we lose all our money. We outsource all that physical production to other countries. And whereas we run surpluses in services like software and other things like that.
I would say IP almost, sort of Apple, all of that. It's intellectual property. It's almost the smart stuff and place to hide out, isn't it? Hold on to the IP, license everything out, and get it made elsewhere.
And it works. It's good to have a high valued economy. Like the fact that we have a lot of tech exposure is one of the best things about the country's economy. However, it creates it creates two economies, right? Because if you're a knowledge worker, if you're involved in tech, or if you're involved in finance or involved in government, you make a ton of money and you kind of benefit from the system as currently structured. If you are blue collar work, whether or not it's unskilled work or even very skilled blue collar work, like you're an expert craftsman, for example, it's still like your buying pressure, your kind of like your ability to sell your labor to a company is vastly reduced because those companies can automate or offshore, and kind of we've structured in a way that they are very incentivized to do that because we tax mostly at the point of hiring someone rather than the point of profit. So from a company's perspective, they want to make as much profit as possible and hire basically as few Americans as possible to do that. And that's how we've structured our system. And so, for example, if you had a system where you tax profits more, but employment less, we would have less extreme of kind of an incentive to be a software company or these other kind of like outsourcing and automation and things like that.
I actually comment that what I see as the great reset that's coming in, the solution that will be proposed from the problem, the reaction, and then the eventual solution. It almost, a reset is a great polarizing event. And it seems by virtue of the systemic design, part of which comes through from Triffin's dilemma, where you have to have deficits. You can choose in what area you do those deficits. So you say, okay, go do manufacturing, we'll hold IP, which was probably the sensible choice if you have to do it. You end up, as you say, with high intellect type work and service sector work, which of high value in the tech and the pharma area being highly paid. And that almost splits your population into, maybe some people will say STEM even because but bio kind of fits into STEM a little bit, but maybe not purely. And then you end up with blue collar and all other service sector. I mean, from people serving coffees and working in McDonald's, they're actually on this low road that is very menial. They still have some degree of personal taxes. You could see that was quite high. I'm not quite sure where the personal tax rate kicks in the States. But it does seem that the population will be split as well in terms of how this is, and it might be part of the social unrest that we're seeing in the Kindle, the very what's it, fire friendly Kindle that can be lit for social unrest, given this divergence of path and the perceived unfairness as a result. I mean, you're not a social commentator on that, but given the political discourse and we're going into election, how do you see events leading into the election? Funny enough, I'm not necessarily seeing Biden despite polls winning. I think polls can be slightly skewed. We were on the Brexit and the Trump winning, and I'm going to stay with my batting average on that and think he actually gets a second term, because I think it almost feels like that social rest needs to be continued for the problem part before our reaction and the eventual solution. And George W. Bush's second tenure was, very inauspicious, if we can say that. He went out in acrimony in a certain sense. And I feel like it almost needs a similar play for, a more socialist friendly Democrat two-termer to follow maybe afterwards. And they really need that. How do you see markets? And maybe do you even, if you dare have a guess, because it's a probability-based game, given the election, any comment around electioneering, what might be good going up to it, how you see it all playing out?
So yeah, I don't currently make a election prediction because it's just not really my area of expertise, and I don't really have an edge on it. I honestly I don't know who's going to win. Biden's ahead in the polls, but so was Hillary. So we'll see what happens come election day. And actually, we probably won't find out for a couple weeks after because it'll probably be contested. I think it's possible we have a split election where one of them wins the popular vote, but not the electoral college. Uh,
Yeah.
there's also a question of, even if Biden wins, will the Democrats win the Senate? So you could have a divided situation, which is what we saw under a lot of the last 2/3 of the Obama administration. We saw that very divided kind of government. So I don't really have a strong opinion on where that's going to end up. Um, Going back on the social point though, if you look at a couple different variables, they tend to align. So for example, if you look at long-term debt cycles in U.S. history, they also align with what Neil Howe referred to as fourth turnings. So he has that social, that kind of demographer. He's a demographer and a historian, so he views like generations going in cycles. So every fourth generation, so roughly every 80 years or so, is a fourth turning where you have a period of great upheaval and resets. And it just so happens, it's not a coincidence that those fourth turnings tend to occur at during periods of the long-term debt cycle kind of hitting an apex. So it happened, according to his methodology, we're currently in a fourth turning. We're in kind of a long-term debt cycle. The previous one was the Great Depression, World War II area, which was the previous long-term debt cycle. Then there was the Civil War era, and then there was the Revolution area. So those are fourth turnings. And also, if you look at wealth concentration. So wealth concentration tends to have ebbs and flows, not just in our society, but literally going back in multiple societies, for 1,000 years. There's documented kind of wealth concentration tends to hit extreme. Then you get more populism, more civil unrest, and usually you get somewhat of a more redistributive regime. And then that kind of reaches its own apex, and then you kind of get a reversal, and you get kind of a more capital friendly environment, and you kind of have that ebb and flow throughout history. So if the previous fourth turning and kind of long-term debt cycle peak back in the 1920s and 30s, we had a very high period of wealth concentration in the U.S. And then over the following decades, that kept going down and down and down, and it bottomed kind of the 60s, 70s period. And then ever since then, we've been building up kind of another kind of period of multi-decade wealth concentration. And so the charts align pretty strongly in that. And when you get that kind of really high level of wealth concentration, that's when you start getting more and more populism. And it's always challenging because people don't know exactly what to blame, right? So populism can take the form on the right and the left, and
Yeah.
and people have different opinions on what the problem is and what the solution is. And so that's when you kind of have that very polarized political situation where instead of kind of meeting in the middle, you're on far extremes, and it keeps going and going and going until someone has a decisive victory. And yeah. Yeah.
My big concern on that is it seems that the failing is being blamed on capitalism, where we really haven't had a true pure capitalism, and that the
Yeah.
solution is actually more government intervention, leaning socialism going into almost oligarchical type communism in a dystopian kind of way. And I just don't. Sometimes it's not the illness that's the problem. It's the incorrectly diagnosis and the subsequent solution that concerns me almost more in terms of what might follow. Because we do certainly have a bunch of oligarchical corporates that I would say are overdue some antitrust inspection. But it seems that government's kind of comfortable for the quid pro quo they might be getting on, and my suspicion is it's a privacy space. But anyway, we're leaving markets a bit. I don't know if you have a comment on that, but what comes next is a slight concern. How do you think it turns out? I mean, if we do go more socialist, what does it mean for equity markets, currencies, more government intervention? Typically, those things are associated with less free markets and being bad for markets generally.
Yeah, so yeah, touching on that point, I think that the main issue is cronyism, right? So it's not capitalism itself that's the current problem. But even if it gets blamed as such, it's really the cronyism and kind of I've called it a toxic blend of fiscal policy that exacerbates. So every political system has downsides, right? So capitalism has certain downsides where there's winners and losers, and it's good and bad, because if you're a winner, it's good. If you're a loser, it's bad. Now, fiscal policies can come in and kind of mitigate some of those and soften the edges a little bit. So we have, social safety nets or other things like that that kind of historically works well with capitalism. So you have that kind of blend of free market and then some sort of safety net for people. Now, when you get kind of a more and more cronyism in that system, right? So we get more and more wealth concentration, and then we kind of give more and more benefits to the top. So you have kind of a two different kind of rule sets, whether it's legal rule sets. So if you're rich, like for example, you're more likely to get off on a crime, whereas if you're poor, you're more likely to go to jail for a long period of time on a similar crime. Or you get kind of financial cronyism where, if you're a super company, you have much better access to capital. You can lobby politicians to rewrite rules in your favor, and you get kind of more and more momentum in your favor until the populists come back and take that away. Now, yeah, then the risk is that instead of blaming cronyism, that they blame capitalism itself. And that's, for example, what you saw in Russia, 100 years ago, where you had that extreme wealth concentration. You had kind of the top class taking advantage of the lower class, and the response to that was to go down that communism route that of course got corrupted, and it just went terribly wrong. And so they've had to start reversing that because they hit the other end of the extreme and found that wasn't working. And so it depends on, it's always hard to predict how a movement turns out, right? Will they blame the correct things or will they blame the wrong things? How kind of skillfully will they thread that needle to fix the specific problems rather than to attack the healthy parts of the system? And that's, I think that's anyone's guess.
I think I was reading just on the financial cronyism. I was reading about American Airlines. I'm going by memory from a tweet, so it's not necessarily the most brilliantly sourced, but I think the gentleman CEO taken 200 million out of the company over the last 7 years, a lot of it through options and various remuneration, laid off 19,000 people after receiving government bailouts for the airline industry. That kind of excessive remuneration, the US seems to be particularly extended in those multiples, sort of blue collar guy, shop floor steward to CEO multiple. And also the concept of the socializing of the downside to government and taxpayer, and then the excessive remuneration to the ruling classes, whilst the stock probably bumps up on the announcement that 19,000 people are laid off, because we're just looking at your newsletter and we're seeing how it's good policy essentially to retrench workers because you reduce your overall cost and actually offshoring. So you actually have all these perverse incentives which are actually exemplified, and this is one of my favorite sayings, is you get the society you incentivize. And are we not just exactly reaping the final cornerstone of crony capitalization through exactly all of these aspects, which, as I say, your newsletter on the Triffin dilemma is great reading, and this tax shift observation totally pulled together for me really extensively.
Yeah, I think it's Charlie Munger that said the quote like you show me the incentives and I'll show you the outcome, right? So uh, and so the combination of Triffin's dilemma and the global reserve currency, like there are strong incentive to run trade deficits and to specifically outsource a lot of our blue collar work. That's kind of come back to bite us in the form of certain segments of society that we hurt pretty bad and that we're starting to get more populism from, and all these different factors, the things you pointed out. And so, we have that situation where, instead of capitalism, we have that blend of, socialism for some people, capitalism for other people, and that's kind of the worst of all possible worlds. And so, and that it can end in various ways depending on whether people correctly diagnose the specific problems or if they blame healthy parts of the system as being causes of the problem. And it's always hard to predict. And eh, this is kind of the incentive structure we've built. And going back to your point on CEO compensation, yeah. So if you look over the past couple of decades, the ratio of CEO pay to worker pay has gone up dramatically, and that's because we've put more and more. We've If you can outsource your labor, it decreases their kind of negotiating power, because it's either if they're too expensive, and if we kind of tax them even more. So we tax employing someone more than we tax profits. The incentive is to go to China, go to Vietnam, go to Bangladesh, hire people there, and so that kind of reduces the negotiating power. And then we the way that the CO compensation works is their performance is largely tied to equity performance, like their compensation is tied to equity performance, and then they can buy back their own shares to
That's right.
help hit their own targets.
Further
And
to
then you
that,
had
in capital that is disproportionately lowly priced, because A, they're a mega corp too big to fail, structurally having bailed out in 2007 and 8 many core
yeah
industries. And subsequently, they've also listed other institutions where we have people like BlackRock and other companies that are now being deemed too big to fail. They get these highly beneficial systems. We hollow out the SME with the pandemic crisis to a large degree. So all lending has to go to almost the ruling classes and is disproportionately low and highly scaled. And you actually have an environment where any bailouts, also reserves, holding too many reserves, can be punitive. So they need clients that can borrow in billions, which I'd love to be able to borrow in billions, maybe to buy some metals, but I don't see anybody lending to me personally or any SME I might be part of. So it's incredibly unique how all the forces seem to have aligned for this. Lyn, let me take you somewhere else and capture your view. I think we're all in agreement that we're in a very powerful equity market for some of the reasons in the US that we've just described and how significant it is globally. This is the NASDAQ. I brought the charts up. By the way, we're probably just witnessing right this minute. I'm just checking the high. The high was 12,048. So I'll just check that on the daily. We might have just caught the month that we traded the high through 12,000. That's yesterday. That might have happened yesterday on the very high, 12,048. So the NASDAQ itself, I'll just go back to the super macro time frame and just log scale it because it is such a hockey stick. It warrants a log scale chart. What do you say to people that are staying out? Is it the most hated bull market because people can't bear to be in? And doesn't that just mean that it's more likely to go up further for a while because there's money in the sidelines? And only when everybody finally capitulates and leverages in do we have our blow off top. How does someone deal with, and how would you handle? And just further to this, a small punt for you. Lyn runs a great, I'm a member on her, premium member on her services, and she does have a model portfolio. I'm not going to disclose what's in that, but I might mention one if she has allowed me. For example, Nvidia is one that you have. It's going to be in that NASDAQ 100. When do you take profits on your Nvidia, or if you happen to have an Alphabet or a Google, at what point will you be deciding? Because we discussed the silver, you might not hold for 9.9 before you close your silver trade. When do you take off the table in this insanity?
So I think a lot of that will depend on fiscal policy and rates. So as we've had this very low rate environment, it's disproportionately disproportionately good for growth stocks. And if anything, I haven't weighed them as highly as I should have. So for example, I added to a lot of my when we had that Q4 2018 sell-off, right? We had a sell-off specifically in some of these growth tech stocks, and it was partially tied to interest rates going up. And so that's, I added like Adobe to the portfolio, I added Nvidia around that time, maybe a little later. And so that was a really good opportunity to buy all these sorts of companies. And so, for example, now companies like Nvidia and Adobe are in their portfolio, but they're getting very rich. Like they've gone up so far, and they've been very strong, performers for the portfolio. But they are getting rich. And if anything, my mistakes so far have been selling some too early. So, for example, I used to have Apple in the portfolio, and it got really cheap in Q4 2018. I kept buying it then, and then as we got deep into 2019 and into early 2020, it started to get very expensive. And so I did sell that one because the growth rate has been pretty slow, but the multiples increased so much. And then I sold it, and then it only just exploded higher anyway. It went from what I would consider kind of moderately overvalued to like terribly overvalued, as an example. And so I guess my way is slowly selling some of the most egregious examples. So for example, Apple doesn't have a ton of growth, and yet its valuation's gone up dramatically. So I've trimmed that one. I'm still holding Microsoft because that one has better growth. I'm still holding Alphabet. I'm still holding Nvidia and Adobe. And so I trim them when they become more and more blatant. And those had a higher threshold for me because they have higher growth, and therefore I have kind of a higher threshold for where I sell them. The sharper catalyst for when I would consider kind of outright selling them is if we get kind of a more confirmed trend shift in treasury yields and fiscal stimulus, things like that. If we kind of get, because we talked earlier, we're kind of in this big question mark. Are we going to go the fiscal route, the more inflationary route, or are we going to go the fiscal gridlock, and then we get more and more monetary kind of outcomes. We get kind of deeper yields. So if we get an answer there, if we get that more inflationary environment, that tends to be good for a little bit more on the value stock side of the spectrum. So it could be kind of rough for the parts of the stock market as a whole, but in general it'd be worse for the very overvalued tech stocks. So for me, kind of a wholesale change of direction, I'm really kind of paying attention to rates, inflation, and then also specifically I'm doing a little bit of ratio work. So for example, I can look at growth to value indices and look at that ratio, so I can see kind of which is outperforming. And I also look at the market weight S&P 500 compared to the equal weight S&P 500. And so when I see kind of certain levels become support, I pay attention to that to some extent. And lately we've been testing that support. So I have a couple different signals. It's no like exact science, and it's partially kind of how I approach that silver thing, where like I start selling the most egregious examples first, and then kind of go from there.
Isn't the narrowing of that advanced decline, the breadth indicators, also a little bit of a concern now? And aren't we? You hesitate to call tops. I call shorting indices almost, a widowmaker for people that want to get into that. But isn't that breadth decreasing a little bit of a concern, and it's leading to that final corner for the crowding out of capital into one space?
Yep. Yeah. So breadth got worse and worse, and so it went down. So there's very, very few kind of left that are climbing. So Apple's been one of them, and Tesla's been one of them. They've been climbing to pretty extreme levels. And I also
Can we talk Tesla just for a second if I jump you in, because I'm very interested in your particular view on this. This one wasn't always in that class. It had a bit of a tricky period. There was Elon Musk's Shortville battle. But we're actually gone very recently. I think in the most recent short term, it's probably one of the biggest performers. You could have had it at 168 June, around about not more than a year ago, at a low there of around, let me just give the exact number, $176. And we're at 2,268 today. What are the justifications for their particular level of outperformance? Are there any that you find plausible? I mean, they're doing power walls, roof tiles. Okay, it's eco, it's green, it's on trend. so's the car and the tech and the self-driving, but 1 million market cap added per car that they've sold relative to Toyota, etc., etc. I mean, I've got to hear your take.
Yeah, my base case is that it's a bubble. So I cited Apple as an egregious example. I think Tesla's possibly the most egregious example. So, for example, if you look at companies like Microsoft, Adobe, Apple, Nvidia, they're doing very well fundamentally. They're very profitable companies. They're growing like wildfire, and I think most of them are getting overvalued, but they're still doing exceptionally well fundamentally.
Yeah.
Tesla's and to some extent even Netflix is kind of in this camp, but Tesla's more extreme. An example of a company that doesn't really produce free cash flow, like so its entire kind of life cycle as a company is still not profitable. It hit over the last 4 quarters, it hit like technical profitability because partially because of the government credits that it received.
So if we talk Amazon, say .com boom, Amazon wasn't profitable, but you would argue that there was always a case for it because they were generating immense free cash flow, just expending it on future reinvestment. In other words, playing a very long cycle to purely dominate and thereby keeping their tax at profit very low by reinvesting so aggressively. So would you differentiate Amazon 99 at $7 post the .com crash from, say, a Tesla on that basis?
Yeah, so Amazon, for example, it had that kind of deliberate policy where it could have been more profitable but chose not to be. And then also its business is inherently kind of it grows like the Borg. Like it keeps kind of building more and more kind of network effects and a wide economic moat, because the more it expands, the easier it is to keep expanding. And then in addition, they made that important decision to do their cloud hosting, right? Because they're running all these servers, and they have to make it so that they have all this extra server space so that if everybody goes to them on a holiday shopping day, they can handle that extra traffic. So most of the time they would have wasted server space, and so it's really, and if you look at online retail, even though online retail has been taking so much market share from physical retailer, it's not that profitable. It's almost a loss leading business. It's not a super profitable business. So Amazon's what really helped them succeed and become the titan that they are is to add that cloud element. So they have that kind of higher margin element that kind of it synergizes very well with their retail sales. So Amazon's been a very good case. They've had stronger and stronger operational cash flows, and so I've always been cautious about Amazon, but never kind of thinking poorly of it in that sense, and kind of saying that it's a bubble or a short. I've always been kind of like, it's hard to value. It's a unique situation. The thing about Tesla is it's a very sentiment driven company. So whereas Amazon can build a wider and wider economic moat, Tesla, its cars can kind of come and go based on how well their current generation is, whether or not there's safety issues, what the public thinks of them. It can kind of be like a trendy thing that can come and go pretty easily. Now they do have some so technological advancements are a form of economic moat that they can work on, and that's kind of the one that they can benefit from. But overall, it's a much kind of more fragile situation than something like Amazon, and they've mostly been free cash flow negative. They issue junk bonds to basically fund themselves. Now, because their equity blew up, now they can do more equity financing. That if anything, if they're smart, they can do more equity issuances and almost turn an insolvent situation into an increasingly solvent situation. Is just because they're, instead of funding themselves from product sales, they fund themselves from
Overpriced equity.
overpriced equity. And so there are a lot of kind of factors here. So one is that there's a big global mandate to have ESG investing, right? So all these sovereign wealth funds and hedge, all these funds around the world want to have exposure to kind of quote green technologies, and Tesla is kind of the poster boy for that particular movement. So there's kind of a lot of capital that isn't very particular. It doesn't really care necessarily even about returns, and it just kind of floods into the space and kind of buys it in the same way that the S&P 500 has to.
A tracker, a tracker has to accumulate. Yes, on that point, I thought Amazon was a very, very good case of very efficient execution. The scaling, the epic scaling first to dominate, and then, as you said, the broadening out into the other industries where they already had inherent need. so that they could scale into AWS that you mentioned and all of those elements. But I don't think we can necessarily say the same about Tesla. I think I use about 10 Amazon employees toilet time. He's been absolutely ruthless on costs and how he manages his people. So yeah, that was just almost sweatshop-esque. It would be really remiss, Lyn, not to take you into the crypto space. I'm going to bring up the Bitcoin chart because I know you've also shared opinion on the crypto realm. We wear three hats. The market sniper is kind of macro technical in traditional markets. The reset sniper is just watching, the social, economic, the political elements. But there's also the crypto hat that we wear, which is on. And I have done certain relative valuations of cryptos just because I like, one of my favorite things in charting is sort of dividing one thing by another. I'm going to choose a Bitstamp actually and try get a bit of longer history here, or maybe just go weekly. But in terms of the chart on Bitcoin, how do you see Bitcoin playing out? Is it going to come back to what does the Fed policy do next? Because to many people in the crypto sphere, they just think it's about crypto. They just think it's about the tech. And I try to remind them that it's an anti-fiat. It's a kind of an anti-dollar maybe. And actual fact, when we see things that are good for gold and silver, we have an anti-fiat category almost that can be subsequently very good for Bitcoin. And it's kind of just a higher beta version of gold in some senses, not to oversimplify that, but technically that we get similar impulses. Where do you start from when you're making your case for any crypto holdings? Because you do have a bullish bias, if I understand correctly.
Yeah, so I started covering the space in 2017, and that was towards the end of that big bull run, and I did not buy any. I was very cautious about it. Uh, since then, we've had that pretty big correction. So we've had, I first wrote about it in late 2017, and so over the couple months after that, it hit that bubble peak and then collapsed, and then it consolidated since then. So it had this big round trip where it didn't really go anywhere for about 2 years since my initial analysis. In April of this year, I turned bullish and went long, and then I've continued to reiterate that long position since then. And there's a couple reasons for that. I think, as you point out, it's the anti-fiat, so it's another way to diversify the gold and silver thesis. And in particular, because gold and silver did very well from 2018, I was kind of like, okay, some of these might be near term overbought, and I'm worried about kind of, I don't know how they're going to do over the next 6 months, 12 months, we'll see. Whereas Bitcoin had been consolidating for that period of time and had done very poorly from the
Yeah.
2017 peak, and
Yeah.
where it is in its halving cycle. So most of Bitcoin's historical bullishness happens in the first half of each of its halving cycles. So those are 4-year halving cycles. The first 2 years tend to be where virtually all of the gains come from.
On that
So it's kind of
point,
like,
isn't it interesting that it's dovetailed exactly into the election cycle as well? I don't know if
yeah,
you think that's by accident or coincidence or just happened to be 16,
yeah.
20.
Yeah, I'm not sure. I know it was started, during the previous financial crisis. So this is kind of there's a lot of factors that work really well here. So you have the halving cycle occurring at a time when, this whole big like macro environment's playing out. So Bitcoin was born in the financial crisis, and now it's experiencing an even bigger financial crisis around the world, in many ways. So yeah, so my view is that it's likely to do better the more liquidity is out there, meaning that if we go back to that kind of either the fiscal route or the monetary route, if you go that fiscal route, that is likely better for Bitcoin. Um, because it's such a small market cap, it can be somewhat uncorrelated because it doesn't take a ton of money to move it, right? So if someone wants to, even if we get the kind of the less ideal macro backdrop for it, I still think it can do reasonably well. I just think it can affect kind of the probability of it doing well, and I think it can affect maybe the magnitude of how well it does. So it's somewhat uncorrelated, but also somewhat correlated to liquidity. And so my basically thesis on Bitcoin is that it's a harder to confiscate, kind of digital precious metal in that sense, and it's in the bullish phase of its halving cycle, and we have a macro backdrop that is likely to favor it over the next couple of years with probably more stimulus, probably more money printing, things like that, some degree of currency devaluation. And so, and it's such a small market cap, and we're also seeing more and more kind of access points to have institutional money be able to flow into it easier. So it started as a retail phenomenon, and then some of the more sophisticated institutional money got in there, like family offices or certain hedge funds.
Yeah.
And so, but now, for example, Fidelity is looking to increase the access points for people, and they manage like $8 trillion, right? So Fidelity getting into it is not a small thing. So we also saw, for example, two companies now officially hold Bitcoin on their books, including a small publicly traded U.S. company, MicroStrategy. So I do think we're basically seeing the network effect of Bitcoin's growing, and my case since April is that it's an asymmetric trade. So you have the bullish part of the halving cycle, you have a ton of liquidity. The upside is multifold potentially, like it can go up multiple times, whereas the downside is if this halving cycle ends up being the first one that doesn't work out, maybe Bitcoin loses half its value, maybe it loses 3/4 of its value. If you use it as a small portfolio position, it's kind of a very asymmetric bet over the next, call it 2 years.
And I like that. I like that as well. The asymmetry, tight risk, expansive, very blue sky-ish reward. And a lot of these trends, as we've discussed on the macroeconomic things, they just can't go away. There's not too many options left on the table. They've got to do, as you say. And I think the fiscal comes before the negative monetary interest rates, because we spoke about that being almost a gateway to the surrender of the banks, which will almost be bankrupted, wholesale bankrupted. And I've even suggested in play out that the banks might be the sort of the sacrificial limb that doesn't make it into the new cycle, and that Bitcoin and the transfer of money and maybe the Fed going direct to the populace, and there's a lot of talk on e-coins and the IMF sort of nodding with interest, and all of these sort of as the one grey pony is growing tired, and the Lone Ranger is worried, the new horse is almost sidling up for him to jump on, and there's maybe going to be a parallel running period. But we could be getting into the early adoption stage. And again, it's still early, even for people that are, just because of the market cap, as you highlighted, significant amounts when we consider about the number of financial assets and the scale of it in other worlds. I mean, even gold, which is not the largest by a long way, is about a 7 trillion market cap. So Bitcoin's got some way to go to be 10% of that, assuming gold doesn't move itself out of the same drivers. So it should be very, very positive. Technically, we think we're in our first major macro consolidation. I don't know if you like charts. I'll share an opinion that we have. This Bitstamp's one of the oldest exchanges. So you get kind of from 2012. And we think that this could overrun, this could be one of our big time frames. People have typically just had an all-time high, then a sell-off and an all-time high, a sort of seesaw up and up and up. And we think that the current economic events have almost kept us in a sustained holding pattern of quite some duration, actually, by Bitcoin's youthful standards. And that we've been held up since 17. We are virtually 21, if you'll allow me to roll into there. I think a substantial move with potential outperformance could happen. But I just have a feeling that there's a moment of fear again. We spoke of the deflationary element that CV19 brought to the equity markets, and there could just be there's a tendency for a shakeout just before a major move in the opposite direction, a sort of what we call a look one way, go the other. That where there's people that are a little bit overzealous, a lot of retail people that still aren't masterful in their trading techniques, that are maybe over leveraged and get shaken out on a downside throw, only to see it rebound. I think that lesson was quite well spoken for in the collapse we had over here. But unfortunately, people, as new blood comes in, some of the old lessons still need to be taught more than once. In terms of that, and to tie into your overall macro fundamental theory. Excellent. Lyn, I want to wind it down and say thank you very much for your time. I'd like to refer everyone who's watching to, once again, to your newsletters. Very, very interesting content, entirely free, all locatable at lynalden.com. Thank you so much for the generous amount of time you've given us. We've talked on so many things, asset classes and categories, and it's been very well informed and very useful. We'd love actually to make a time to check in with you again, maybe, you know, in a spell, once a few more interesting items shoes have dropped, and I'm pretty sure they'll be. But thank you very much for your time. Truly appreciate it. It's been a great session, and I've really, really enjoyed it, and hope to have you on again soon.
Yeah, thanks so much for having me. And I think you asked a lot of great questions and made this a pretty unique conversation. You know, especially because I've done a lot of interviews, and I think that this one has a lot of unique content in it. So I think this just turned out really well.
Oh, that's a pleasure. Thank you so much for that compliment. And it takes great guests to have great interviews. Thank you very much. And with that, we say goodbye to all those watching, and thank you for checking in.